with its ninth consecutive daily loss, longest losing streak on record, I believe. The index, let's see, equal weight S&P up 15% year to date versus I think about 27 for things overall. So it continues to be really rough out there for value investors. Why is it going to get better?
Well, I would say our fund is up 20% this year. I wouldn't call that really rough. I would just say not as good as the large cap growth tech stocks. So it's been a perfectly good year for value investing, just not nearly as good as growth investing. And what we like about this is we think our names are reasonably priced here. A lot of the names that I talk to you about every time I'm on your show, John, are trading at 14, 15, 16 times, not the 27, 28, 29 times in the large cap tech space. So we think we're getting good returns. Our customer is really
to be research, guys. Welcome, Charlie. S&P 500 value index closed yesterday with its ninth consecutive daily loss, longest losing streak on record, I believe. The index, let's see, equal weight S&P up 15% year to date versus I think about 27 for things overall. So it continues to be really rough out there for value investors. Why is it going to get?
Okay, so the value index has to do with their, it can either do with their, it's probably their PE ratio, not the price to earnings ratio. It could be either or. But basically, these guys have a value fund where they look for low PE ratios compared to their earnings. So we'll just, that's what these guys are selling. That's the kind of fund these guys are selling. So we'll see what they have to say.
Get better.
Well, I would say our fund is up 20% this year. I wouldn't call that really rough. I would just say not as good as.
Okay, so for him to say, and this is why people want to buy indexes a lot look, there's some funds that do way better than indexes, but for example, the S&P did better than 20%. But here's another thing too, is that his fund might be built better for resilience, right? Everybody looks like a genius when the markets are going up. Let's see what happens when it goes down, right? So in his defense,
as the large cap growth tech stocks. So it's been a perfectly good year for value investing, just not nearly as good as growth investing. And what we like about this is that we think our names are reasonably priced here. A lot of the in a growth fund. So if you have a growth company, right, you're putting all your money back into growth, right? You're not going to have like earnings or anything like that. So that's what he's talking about. And a growth fund, and I'm surprised. I think the growth funds are growing right now because the interest rates had been going down, but because of what the Fed did the other day, you saw some shocks in a lot of those funds. A lot of the names that I talk to you about every time I'm on your show, John, are trading at 14, 15, 16 times, not the 27, 28, 29 times in the large cap tech space. So we think we're getting good returns. Our customers are happy. We would not have predicted a 20% return this year, and we got it. Reasonable valuations, reasonable growth, good growth in our companies, not a bad place to be.
Sounds like a tortoise in the hare expectation there. James, you say to buy any weakness in the market overall. You predict S&P 6150 by year end, but you expect a 10 to 15% correction at the beginning of 2025, and that AI stocks and these big stocks are going to do worse and then come back. How do you?
And you kind of saw that with the Fed's last, with their last report. But a lot of the correction that he's talking about is a lot of people do tax harvesting around this time, and a lot of stuff gets mixed up. So you see a lot of buying and selling.
Expect that to work, especially can the market come back without these big AI names, big names and AI names coming back too? Let's see, I'm not hearing James. Charlie, sorry, let's get your audio fixed, James. Not quite hearing you there. Charlie, you expect that healthcare and food stocks, which have responded negatively to the idea of RFK Jr., you think they're overdone. Which ones in particular do you see opportunity in?
Yeah, there are a lot. I'm glad you called this out. We think that he is got some ideas that wouldn't be good for healthcare and food, but that he's not going to be as successful in getting those changes as the market reaction would have you believe. So,
and I would just say this, and I'm not telling anybody to buy and sell or anything like that, but I would be concerned personally if I was holding some of the pharmaceutical companies right now, because there's just a lot of uncertainty.
A name like Smucker's, which has historically been a high teens multiples, now trading for about 14 times earnings. That's a very attractive name. LabCorp is a name there's going to be more testing done going forward, including on new drug development. Stock's been hit. LabCorp trading at a very reasonable valuation. And then J&J, of course, one of the best healthcare names. It's been a great strategy to just buy J&J and put it away, is now trading at 14 times forward earnings. That's a name that's...
So what you can do when he's talking about these earnings multiples is you can see what the standard earnings, and it wouldn't be this for growth. Growth is a whole different, ball of wax. But you can see what the standard multiple is, and you can see where these companies' multiples are, right? And you can see kind of what is the better value to buy.
It's been a premium to the market for decades and now trading at a discount valuation. So healthcare and food is a place that we think has been overly scared by the prospect of Mr. Kennedy.
Interesting, James. I believe we got you now. So you expect a down 10 to 15% in the S&P in Q1, but we end the year 12 to 15% higher. How does that work? Do you expect mega caps and maybe some of these AI names to be as strong at the end of the year as at the beginning? Because if so, they're going to take quite a round trip.
And I'll say this: that could happen. There's just a lot that's going to happen, and some of the stuff happens retroactively. So, for example, all the tariffs, you're not going to see that in the markets right away. It takes a little bit for it to show in some of the economic data, but that is a potential disruptor, and that could shake things up. The other thing you have to consider, what they kind of mentioned, is that things are at very, very high multiples right now. So in order for that scenario to take place, I would think that earnings and productivity level have to increase, right, for that to continue.
Yeah, I think it is going to be a round trip. It's been very generous for the AI trade, particularly the semis, but we think 2025 is going to be very different. Number one, we're going to have a startling correction, probably pretty deep for those AI companies because of their higher valuations. But we see 2025 as not a Fed-driven market or all that cash on sidelines, but the economy and earnings are what drive stocks. And that'll help Charlie's stocks because it's going to broaden. But we think that big decline might be because the Fed is going to be unable to lower rates in the first quarter. That might be startling. That might have a good sell-off in the tech stocks. But let's remember one thing: we're early in the AI transformation, and as Broadcom suggested and looked at today with the report, we think there's still lots of legs to AI, but it's going to be second derivative AI companies. So yes, the NVIDIA's, Broadcoms do well in 2025, but those second derivative software companies, telecommunications.
So just to add on to what he's saying. I think since this was recorded, the Fed announced that they weren't going to be cutting. They indicated, I should rather say, that they weren't going to cut rates. So what this means to a tech company or a growth company, you need money. You need money for growth. So the borrowing rate is going to be higher, which is going to hinder their growth. So those type of companies are very, very, very sensitive to those hikes or cuts.
Okay.
Catch up.
So what potentially derails your thesis? If tariffs don't go as you expect, rates pause for a while?
What really derails us is the pro-growth deportation of Trump policy sort of igniting inflation again. The Fed comes back to the table to raise rates. I think that really calls.
And look, I just got to say, like, I like Trump as the next guy, but a lot of, and really, I don't think there's any better way to do it than he's going to do it, but a lot of what he's going to do is pro-inflation. The immigration is going to be pro-inflation. The tariffs are going to be pro-inflation. I don't know if he's really going to do the tariffs or is just using it as a negotiating piece. But that should be a concern. You didn't really see high inflation last time he did it, but at the same time we have like more challenges because all the money that was put into the system last time.
A very disruptive market, a very difficult market, or possibly a U.S. credit downgrade. Other than that, we think normal correction, maybe deeper for tech, and people buy that. If you're not fully invested, you want to wait for that, and you want to buy into that correction in the first quarter.